When the fraud is so big that stopping it would collapse the economy. When the criminals are too important to prosecute. When everyone knows and nobody speaks. There's a moment in every systemic fraud when the people in charge face a choice. They can sound the alarm and watch the system collapse. Or they can stay quiet, hope they're wrong, and pray someone else deals with the consequences. That moment came in 2006. Analysts were noticing something strange. Home prices were rising faster than incomes. Mortgages were being given to people who couldn't afford them. Financial instruments nobody understood were spreading through the banking system like a virus. And the people who were supposed to prevent disasters, regulators, rating agencies, bank executives, were either profiting from the chaos or pretending it wasn't happening. The frauds we've covered so far destroyed companies. Ponzi, Madoff, Enron, Theranos. They were catastrophic for their victims, but they were contained. What happens when the fraud isn't a company but an entire industry? When it's not executives lying to investors but the financial system lying to itself? 3 frauds, 3 institutions that were supposed to be safe, 3 collapses that proved the system wasn't designed to protect people. It was designed to protect itself. And when it all came crashing down, the people who caused it walked away. The people who trusted it lost everything. When the fraud is so big that stopping it would collapse the economy. When the criminals are too important to prosecute. When everyone knows and nobody speaks. Lehman Brothers was 158 years old when it died. It had survived the Civil War, the Great Depression, 2 world wars, and countless financial crises. It was a pillar of Wall Street, the 4th largest investment bank in America, a place where careers were made and fortunes were built. And in September 2008, it collapsed in less than a week. The seeds of Lehman's destruction were planted years earlier, during the housing boom of the early 2000s. Home prices were soaring, mortgages were easy to get, and Wall Street had discovered a way to turn those mortgages into gold. Here's how it worked. Banks would issue mortgages to home buyers. Then they'd bundle thousands of those mortgages together and sell them as securities, mortgage-backed securities, or MBS. Investors loved them. They paid steady returns based on homeowners making their monthly payments, and they were supposedly safe because they were backed by real assets, houses. The problem was quality control, or more accurately, the complete absence of it. In a normal world, banks are careful about who they lend to. They check credit scores, verify income, make sure borrowers can actually afford the loan. But when you can sell the mortgage to someone else immediately, you stop caring whether the borrower can pay. You care about volume. The more mortgages you issue, the more you can sell, the more money you make. Lehman Brothers became addicted to mortgage-backed securities. They didn't just buy them, they created them, packaged them, sold them, and kept huge quantities on their own books as investments. By 2007, Lehman had over $600 billion in assets, much of it tied to real estate. But there was a problem beneath the surface. Many of those mortgages were subprime, loans given to borrowers with bad credit, low income, or no documentation at all. Loans that were designed to fail. Adjustable rate mortgages with low initial payments that would balloon to unaffordable levels after a few years. Loans given to people who were told not to worry about the details because home prices always go up, except they didn't. In 2006, home prices stopped rising. Then they started falling, slowly at first, then catastrophically. Homeowners who'd been counting on refinancing when their adjustable rates kicked in suddenly couldn't. Their homes were worth less than they owed. They started defaulting. Foreclosures spiked. And the mortgage-backed securities that Wall Street had treated as safe investments started collapsing. If 10% of the mortgages in a security defaulted, the entire security could become worthless. Lehman Brothers was holding billions in securities that were rapidly becoming toxic. The executives at Lehman knew they were in trouble, but instead of acknowledging the problem, they hid it. They used accounting tricks to temporarily move toxic assets off their balance sheet at the end of each quarter, a maneuver called Repo 105. Lehman would sell assets to another entity with an agreement to buy them back days later. This made their balance sheet look healthier than it was during reporting periods, while hiding the true scale of their exposure. It was fraud, not ambiguous accounting or aggressive interpretation. Fraud. Lehman's own accounting firm, Ernst & Young, knew about Repo 105 and signed off on the financial statements anyway. The auditors, whose job was to protect investors, looked at deliberate deception and called it acceptable. Throughout 2008, as Bear Stearns collapsed and was sold to JP Morgan, as other banks took massive losses on mortgage securities, Lehman kept insisting they were fine. Their CEO, Dick Fuld, told investors the bank was strong, well-capitalized, positioned to weather the storm. He was lying. Internally, Lehman was hemorrhaging money, desperately seeking buyers, begging for a government bailout. The government said no. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. $613 billion in assets, worthless overnight. 26,000 employees lost their jobs. Investors lost everything. And the shockwave rippled through the global financial system. Stock markets crashed. Credit froze. Banks stopped lending because nobody knew which institutions were holding toxic assets and which were stable. The entire financial system came within hours of complete collapse. ATMs almost stopped working. Businesses couldn't make payroll. The Great Recession, which had been building for months, became inevitable. Dick Fuld was never charged with a crime. Ernst & Young paid a settlement but admitted no wrongdoing. The executives who'd used Repo 105 to hide Lehman's problems walked away with their fortunes intact. Nobody went to prison. Lehman Brothers proved that systemic fraud doesn't require a mastermind. It just requires everyone in the system doing what's profitable instead of what's right. Mortgage brokers issuing bad loans, banks packaging those loans into securities, rating agencies giving those securities perfect scores, investment banks buying them, auditors signing off on fraudulent accounting, regulators looking the other way. Every participant made rational individual decisions that collectively created a catastrophe. And when it exploded, the people who caused it blamed the system, not themselves. The seed wasn't greed. It was systemic moral hazard. The knowledge that you could profit from risk while someone else absorbed the losses. And Lehman was just the beginning. To understand how bad Lehman could have been, look at what happened 20 years earlier. The savings and loan crisis of the 1980s was a dress rehearsal for 2008, a test run that should have taught regulators, banks, and politicians what happens when you deregulate financial institutions and let them gamble with depositors' money. Nobody learned. Savings and loan associations, S&Ls, were boring institutions. They took deposits from regular people and made home loans. They were conservative, stable, and essential to American home ownership. By law, they could only invest in residential mortgages and government bonds. Low risk, low reward, but safe. Then, in the early 1980s, Congress deregulated the industry. S&Ls were suddenly allowed to make commercial real estate loans, invest in junk bonds, and engage in speculative activities they'd never been permitted to do before. The theory was that deregulation would make them more competitive and profitable. What it actually did was turn them into casinos. S&L executives, suddenly free from oversight and restrictions, went wild. They made loans to developers for shopping malls and office buildings that had no chance of being profitable. They invested in junk bonds issued by companies that were essentially bankrupt. They financed their own lavish lifestyles. Private jets, luxury apartments, expensive art with depositor money, and they did it all while knowing that if things went wrong, the federal government would bail them out. S&L deposits were insured by the FSLIC, the Federal Savings and Loan Insurance Corporation, which meant depositors wouldn't lose money even if the S&L failed. It was the perfect setup for fraud. Take huge risks with other people's money, keep the profits if it works. Let taxpayers cover the losses if it doesn't. Charles Keating was the poster child for the crisis. He ran Lincoln Savings and Loan in California, which he treated like his personal piggy bank. He bought a luxurious hotel in Arizona. He invested heavily in junk bonds from his friend Michael Milken, the Wall Street financier who'd later go to prison for securities fraud. He paid himself and his family millions in salaries and bonuses while Lincoln's financial position deteriorated. When regulators started investigating Lincoln, Keating used political connections to protect himself. He donated over $1 million to 5 U.S. senators, later known as the Keating Five, who pressured regulators to back off. The senators claimed they were just constituent services. It looked like corruption. Keating kept operating for years longer than he should have because politicians ran interference for him. Lincoln Savings finally collapsed in 1989. The bailout cost taxpayers $3 billion, but Lincoln was just one of over 1,000 S&Ls that failed during the crisis. The total cost? Over $160 billion in today's money, with taxpayers covering most of it. Charles Keating went to prison for fraud, racketeering, and conspiracy. He served 4 years before his conviction was overturned on a technicality. He died a free man in 2014. But the real crime wasn't what Keating did, it was what the system allowed. Congress deregulated an industry without proper oversight. Regulators were understaffed and underfunded. Politicians took donations from the same people they were supposed to regulate. And when it all collapsed, taxpayers footed the bill while the executives who'd caused the crisis walked away wealthy. The savings and loan crisis was a warning. It showed exactly what happens when you combine deregulation, moral hazard, and political corruption. It proved that financial institutions will take catastrophic risks if they know they won't bear the consequences. 20 years later, the same dynamics that destroyed the S&Ls nearly destroyed the entire financial system. Deregulation of mortgage lending, risky investments in complex securities, political connections protecting bad actors, and the same result, ordinary people lost homes and savings while executives kept their fortunes. The system didn't learn from the S&L crisis, it perfected the model. Lehman Brothers was the most visible casualty of the 2008 financial crisis. The savings and loan crisis was the warning shot nobody heeded. But the real monster, the fraud that nearly broke the global economy, was the subprime mortgage machine that fed both disasters. This wasn't one company or one executive. This was an entire industry conspiring to profit from loans they knew would fail. Start with the mortgage brokers. In the early 2000s, they were selling mortgages like used cars. Ninja loans, no income, no job, no assets. Liar loans where borrowers self-reported income without verification. Adjustable rate mortgages with teaser rates that would explode after 2 years. Mortgages given to people who couldn't afford them, with brokers assuring them that rising home prices would save them. The brokers didn't care if borrowers could pay because they weren't holding the loans. They were selling them to banks immediately. They got paid on volume, not quality. The more mortgages they issued, the more money they made. If the loans failed later, it was someone else's problem. The banks took those mortgages and did something brilliant and evil. They bundled thousands of loans together into mortgage-backed securities and sold them to investors. To make these securities attractive, they sliced them into tranches, different levels of risk and return. The senior tranches got paid first and were supposedly safe. The junior tranches absorbed losses but paid higher returns, except the banks didn't just bundle prime mortgages with borrowers who had good credit. They mixed in subprime mortgages, loans to people with bad credit, low income, or no documentation. They took risky loans that should never have been issued and hid them inside securities alongside legitimate mortgages. Then came the rating agencies, Moody's, Standard & Poor's, Fitch. Their job was to evaluate these securities and tell investors how risky they were. They gave the highest ratings, AAA, the same rating as U.S. Treasury bonds, to securities packed with subprime mortgages. They claimed these securities were virtually risk-free. Why? Because the banks paid them to issue ratings. The rating agencies were being paid by the same institutions whose products they were evaluating. It was a conflict of interest so obvious that a child could see it. But the agencies issued the ratings anyway, because if they didn't, the banks would take their business to a competitor. Investment banks like Lehman, Bear Stearns, and Merrill Lynch bought these securities. Pension funds bought them. Insurance companies bought them. Foreign banks bought them. Billions of dollars flowed into mortgage-backed securities that were fundamentally toxic, all because everyone in the chain was profiting from the fraud. But it got worse. Wall Street invented synthetic CDOs, collateralized debt obligations. These were bets on mortgage-backed securities. You could create a CDO that would pay out if a particular set of mortgages failed. Then you could bet against that CDO with another synthetic instrument. You could create infinite layers of bets on the same underlying mortgages, multiplying the damage exponentially. Some traders understood what was happening. They knew the mortgages were garbage, the ratings were lies, and the system was going to collapse, so they bet against it. Michael Burry, a hedge fund manager, famously shorted the housing market and made billions when it crashed. He tried to warn regulators. Nobody listened. The collapse came in waves. First, homeowners started defaulting when their adjustable rates reset and they couldn't refinance. Then the securities backed by those mortgages started failing. Then the banks holding those securities realized they were sitting on billions in worthless assets. Then credit froze because nobody knew which banks were solvent and which were about to collapse. Bear Stearns failed in March 2008 and was sold to JP Morgan in a fire sale. Lehman Brothers collapsed in September. Merrill Lynch was sold to Bank of America. AIG, the insurance giant that had sold insurance on mortgage-backed securities, needed an $85 billion government bailout. Washington Mutual failed. Wachovia failed. The government stepped in with the Troubled Asset Relief Program, TARP, a $700 billion bailout of the financial system. The Federal Reserve dropped interest rates to near zero. Central banks around the world injected trillions into the economy to prevent complete collapse. 9 million Americans lost their homes to foreclosure. 8 million lost their jobs. Retirement accounts were decimated. The stock market lost over half its value. The global economy contracted for the first time since the Great Depression, and the people who caused it, the mortgage brokers who issued fraudulent loans, the bankers who packaged toxic securities, the rating agencies that lied about risk, the executives who knew the system was collapsing and kept profiting anyway. Almost none of them went to prison. The Department of Justice investigated. They found evidence of fraud at every level, and they decided that prosecuting the executives would be too destabilizing for the financial system. The banks were too big to fail. The executives were too important to prosecute, so they let them settle with fines, paid by shareholders, not the executives personally, and nobody faced criminal charges. One trader went to prison. Kareem Sarageldin, a mid-level Credit Suisse executive, served 30 months for overstating the value of mortgage bonds. He was the only Wall Street executive criminally convicted for crimes related to the financial crisis. The executives who ran Lehman, Merrill Lynch, Bear Stearns, Countrywide, and dozens of other institutions that caused the crisis never faced criminal prosecution. They paid fines, they gave up bonuses, they moved to other jobs, and they kept the fortunes they'd made while the system burned. The subprime mortgage crisis wasn't a fraud committed by one person or company. It was systemic corruption involving thousands of participants across an entire industry. Mortgage brokers, banks, rating agencies, investment firms, insurance companies, and regulators all played their part. And the message sent was clear. If you're big enough, important enough, connected enough, you can commit fraud at a scale that destroys millions of lives, and you'll walk away. The numbers are incomprehensible. 9 million foreclosures, 8 million jobs lost, over $19 trillion in household wealth evaporated. The worst economic catastrophe since the Great Depression. But focus on this instead. A couple in Nevada who'd worked their entire lives and bought their first home in 2005. The mortgage broker had put them in an adjustable rate loan they didn't understand. The initial payment was affordable. Then in 2008, the rate reset. Their monthly payment doubled. They tried to refinance, but their home was now worth less than they owed. The bank foreclosed. They lost the house and their $20,000 down payment. They were 62 and 58 years old. They lived in a rented apartment for the next decade, never able to afford another home. A man who'd worked at Lehman Brothers for 18 years. Not an executive, a middle manager who'd built a modest career and invested his retirement savings in Lehman stock because the company encouraged it. When Lehman collapsed, he lost his job and his entire retirement account in the same week. He was 53. The job market for middle-aged finance workers in 2008 was non-existent. He eventually found work as a high school math teacher, earning a third of his Lehman salary. He'll never retire. A factory worker in Michigan whose pension fund had invested heavily in mortgage-backed securities. The fund lost 40% of its value. His pension was cut by 35%. He'd been planning to retire at 65. Instead, he worked until 71. He died 18 months after retirement. He never got to take the cross-country trip he'd been planning for 30 years. These weren't people who took risky bets. They didn't speculate on subprime mortgages or invest in synthetic CDOs. They worked, saved, trusted the system, and were destroyed by people who knew the system was fraudulent and profited from it anyway. The executives who caused the crisis, Dick Fuld, Lehman's CEO, left with over $300 million in compensation earned during his tenure. Angelo Mazzillo, CEO of Countrywide Financial, which issued some of the worst subprime loans, walked away with over $400 million. Stan O'Neill, who ran Merrill Lynch into the ground, left with a $160 million severance package. They testified before Congress. They apologized for mistakes and errors in judgment. They claimed they'd been victims of market forces beyond their control. They never admitted fraud. They were never charged with crimes. They retired to estates and country clubs while the people whose lives they'd destroyed struggled to survive. The Lehman collapse showed what happens when one firm fails. The S&L crisis showed what happens when an industry is deregulated. The subprime mortgage crisis showed what happens when the entire financial system becomes a fraud machine where everyone profits from lies until the lies stop working. And the system's response? Bailouts for banks, foreclosures for families, bonuses for executives, pink slips for workers. Justice was never part of the equation. 4 days, 12 scams, a pattern emerging. Day 1, individuals who lied to believers and stole millions. Day 2, corporations that lied to investors and stole billions. Day 3, companies that sold products they knew didn't work. Day 4, an entire industry that committed fraud so massive it nearly destroyed the global economy. The scale keeps increasing, the complexity keeps growing, but the core truth remains unchanged. Fraud works because systems protect fraudsters, not victims. Lehman used accounting tricks that auditors approved. The S&Ls gambled with deposits that were federally insured. Subprime lenders issued loans they knew would fail and sold them to banks that packaged them as safe investments rated by agencies that were paid to lie. At every stage, someone should have stopped it. Regulators, auditors, politicians, boards of directors, journalists, someone. But they didn't, because stopping it would have been unprofitable. Stopping it would have required admitting the system was broken. Stopping it would have crashed markets and ended careers. So they let it continue until it collapsed on its own. And when it did, they bailed out the institutions and abandoned the people. 9 scams left. And tomorrow, the fraud moves again. From financial systems to information systems. From stealing money to stealing data. From crimes that destroy savings to crimes that destroy privacy, democracy, and truth itself. Where the fraud isn't hidden anymore. It's the business model, openly practiced, legally defended, destroying society one data point at a time, and where the victims aren't just investors or homeowners, they're everyone, all of us, simultaneously.